Financials have been on a tear into Trump 2.0. Now this coming as deal making and private credit continue to get a boost ahead of anticipated policy changes. For more on the big themes to impact the banking sector heading into the new year, we want to bring in Alex Blostein. He is Goldman Sachs, a global investment research senior analyst. It's great to have you on the program. You know, it's tough to have a conversation with one of the top strategists on Wall Street and not talk about the opportunity that lies ahead for the financial industry. I'm curious, as you just wrapped up your two-day financial services conference, what was your biggest takeaway just in terms of some of that optimism and confidence that you heard as you look ahead to 2025?
Yeah, great. Well, thank you for having me. Pleasure to be with you. So we did host a conference over the course of the last 2 days. We hosted about 100 executives across financial service industry, ranging from banks to brokers to asset managers. So it's a really wide range of perspectives. So it was a great way to get a check on the pulse of the industry heading into 2025. And what I would say is there's a number of takeaways that really stood out. To your point, there's a lot of optimism there around the economy, and we got a couple of data points supportive of that. I'd say second, the amount of capital market activity, the pent-up capital market activity, seems to be translated into some of the more actionable steps. So whether it comes to equity markets or M&A activity, that is likely to accelerate pretty materially into 2025. The other theme we've heard, and you mentioned private credit, but I would expand it out a little bit broadly. All things around private markets continue to feel really healthy. And for the last several years, it's been largely the story of private credit. We're starting to see that broaden out a little bit into private equity. It sounds like things in real estate are starting to get a little bit less bad as well. And the last point I would make, and we can dig into all of these, there's still tremendous amount of capital sitting on the sidelines. So there's something like $7 trillion of money sitting in cash, money market funds, that is starting to make its way into the market. It's starting in fixed income. It may extend into equities. But all of these things seem to be really bullish for financials into 2025.
What's kind of the third level play for the money market funds, that cash sitting on the sidelines? How likely do you think it is that we could see some of that money flow into something like private credit heading into 2025?
Yeah, so these are kind of slightly different factors, I would say. The growth in private credit has been a bit more structural, and we continue to like that theme a lot for the whole space. It has been unfolding on the institutional side for quite some time. Wealth management and retail has been a newer growth opportunity for the space. We've seen a number of very large asset managers pursuing this opportunity both organically and inorganically, and that is likely to continue. We don't really see any signs of that slowing down. The more cyclical aspect, which is more traditional style funds, is where you're probably going to see a bigger incremental impact from a cyclical perspective. So that $7 trillion that I mentioned, typically that would go into bond funds or equity funds. We would have thought that the fixed income industry would have seen more of that flow at this point in the cycle already. That hasn't happened yet, but as rates start to come down and the yield curve steepens, we think it's a tremendous amount of capital that could move back into the market.
Alex, you mentioned that deal activity. You mentioned some of the confidence that you're hearing from executives at the conference, also I'm sure from some of your clients. When we talk about what that uptick is going to look like, I guess how big of a dramatic change are you expected to see here in the next year?
Yeah, so the two areas that people will talk most about is equity capital markets and M&A. On the M&A front, we are running about 10 to 15% below cyclical averages, and that is not adjusted for the notional, right? So the markets went up quite considerably. So you could argue you could be up, 15, 20, 30% in terms of M&A volumes over the next couple of years. If you look at the equity capital markets, in 2024, I think we've been running something in the 30 to 40% below where we peaked in kind of 2021 period. And there's a lot of pent-up demand. We think a lot of companies that I cover, the private markets firms, private equity firms, they have not returned a ton of capital to their clients over the last couple of years. So we think they will use both the M&A route as well as the equity capital markets route to get some of that capital back out. Because frankly, two things, right? Financial conditions are very easy. Spreads have contracted pretty materially. So availability of financing across the banking industry and the private credit industry is probably as good as it's been in a long time. So financing conditions getting better is a good sign. And then, of course, equity market valuations are running pretty high as well. So that should give people an opportunity to actually deliver on some of those exits.
So to put a bow on this a little bit, do you anticipate 2025 finally being a big exit year?
It feels like it, right? When you take that pent-up demand and when you also couple that with probably a more relaxed regulatory backdrop, that should feel pretty good. Whether it's antitrust dynamics getting a little bit easier, or as I said, just financing conditions continue to be pretty strong, I think that creates a pretty healthy recipe for some of that exit activity to finally kick in.
Alex, investors right now, or our audience who's looking to take advantage of this, what's the top pick then, the top play?
Yeah, look, we continue to like alternative asset managers. It's the space that we've recommended for quite some time. Some of our top picks there continue to be KKR, Apollo, TPG. TPG is a place where the multiples have not run as much, and they're quite levered to this private equity cycle. It's still the majority of what they do. When you look at KKR or Apollo, very different type of companies, but levered to a lot of the same themes as well. With Apollo in particular, you brought up private credit. It's a place where we continue to see a long runway, and then they're one of the better companies positioned to benefit from that as well.
Alex, thanks so much for joining us. I should also mention that Apollo is the parent company of Yahoo Finance.